Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. And in this episode, we have a really interesting topic that will change the way that you think about a lot of Pennsylvania's natural gas fields, particularly the Marcellus Shale, which is a very well-known formation for the production of natural gas, and it's been so for more than a decade. But this new study that we recently covered in our July 2024 news episode highlights the potential for another valuable mineral, namely lithium, which seems to be in the news all the time at this point.
You said it, Matt. Yeah, and it's interesting to kind of dive into this study. We covered it on a high level in our July news episode, but it's pretty eye-opening once you really dive into it.
Yeah, exactly. And like we alluded to in that episode, we wanted to do a deep dive on this topic to really uncover what they found in this study. So we're going to try to break this down in layman's terms for you. So if you own minerals and royalties in Pennsylvania or in surrounding states, this is definitely something to pay close attention to because it seems like Pennsylvania could supply a good amount of the demand that we have for lithium based on the data that they've found. So Justin, do you want to talk a little bit about some of the background and, why lithium is it in the news right now?
Yep, let's set the stage here. Imagine this. The same wells that have been pumping out the natural gas in Pennsylvania could be producing something equally valuable, which is lithium. It's the key ingredient in electric vehicle batteries, smartphones, and something that we have a large demand for. Lithium has become one of the most sought after minerals in the world. As we transition to electric vehicles and renewable energy storage, demand for lithium is skyrocketing. U.S. government's pushing hard for domestic storages of this crucial metal, aiming to reduce dependence on some foreign suppliers. And that's where our story gets interesting, Matt. The Marcellus Shale, as we've been producing there in Pennsylvania for many years, and it's known to be a major source of natural gas. But the kicker is that the water that comes up alongside the gas, known as produced water, contains significant amounts of dissolved lithium. To go further into that with the numbers, they're pretty eye-opening, as we mentioned. According to the recent study, Pennsylvania could produce about 1,160 metric tons of lithium per year from that produced water. And that is a massive amount, Matt, and it really makes up a very large percentage of the usage in the United States.
Yeah, you hit the nail on the head. And a quote from this article says that annual domestic lithium consumption is estimated at 3,000 metric tons. Astoundingly, statewide lithium mass yield estimates suggest the Marcellus Shale production wastewater from Pennsylvania could meet 38 to 40% of current domestic consumption, assuming 100% lithium recovery and extraction processes are more cost-effective than competing uses for the water. So in other words, that you would actually go through the process of extracting the lithium rather than just treating the water and using it for something that the operator would get more value from. So obviously there's a lot of assumptions that go into this, and we'll talk about some of those. But I think it's really important to think about because right now, at least as far as I could tell in the research that I did, it doesn't look like they are exploiting this potential lithium and, extracting it and selling the lithium and doing all of the things that they're doing in the Smackover Formation in East Texas and Southern Arkansas, which we've talked a lot about in previous episodes. And if you haven't listened to it already, be sure to go back and listen to episode 208, The Rise of Lithium and Implications for Mineral Rights Owners, because we dive into some of the things that are going on in the Smackover, which has really been the focus, Justin, for lithium extraction in the U.S., but it seems like a lot of these other shale basins and plays also have valuable lithium potential as well.
You said it, Matt. Yeah, we talked in the episode or some previous episodes about some test wells that have been set up. And right now it's being kept pretty under wraps as far as the details of that go. But it'll be really interesting to see what the findings of that are. And ExxonMobil, they've really been pushing that forward. And it's been interesting to kind of look and see what's going on. According to a study we found, the Gulf Coast Smackover really contains between 146 and 386 milligrams per liter of lithium, and the total resource is estimated at between 750,000 to 1 million tons of lithium. And Matt, if we compare that to the Marcellus Shale, which is from the Devonian age, is estimated at a similar concentration between 148 to 277 milligrams per liter, and a total resource potential of 1.44 to just over 8 million tons. And so, Matt, we're really finding that there's some significant amount of lithium in this that could help to contribute to what the United States is looking for.
Yeah, exactly. In fact, it looks like the Marcellus could actually contain more total lithium than what we see in the Smackover. So it could be actually one of the primary sources of lithium going forward if it's economic to extract it and to use it for, all of the downstream uses like the lithium ion batteries and things like that. But, let's dive into this, Justin, and talk about some of the details here. Pennsylvania's natural gas production is really concentrated in two areas, northeast and then southwest parts of the state. And as you can imagine, as the geology varies across the state, the lithium concentrations also vary. And in northeast Pennsylvania, the produced water has a higher concentration of lithium, but the wells produce less water overall. Whereas in southwest Pennsylvania, they have lower overall lithium concentrations in the produced water, but those wells produce a lot more of the water itself. So you can think about it in terms of the volume of lithium that could be extracted. It's the more water you get, even though it's an overall lower concentration, they might actually have more lithium there. And then the kind of tricky thing is Southwest Pennsylvania produces about twice as much water, but only has about, say around 30% more lithium than the northeastern counterparts, the wells in the northeastern part of the state. So it just depends on a well by well basis and then, area by area basis. So within this study, what they try to do is take that empirical data that is reported to the Department of Environmental Protection, or the DEP, within Pennsylvania. And because when they produce water, they have chemical and production compliance data that they have to report. And within that, they have information like total dissolved solids, including apparently lithium concentrations. And so from that, this study took that data that is being reported to the state and then figuring out what that untapped potential of dissolved lithium that is contained within the produced water that is right now a byproduct of the current natural gas production within the Marcellus Shale in Pennsylvania. But if this is economic to extract, it could be something that becomes one of the other primary targets that they go after and they monetize in addition to the natural gas. We'll talk about the details within this, but then at the end, we'll also dive into what the takeaway is if you're a mineral owner in Pennsylvania and some things that you should think about if you're getting ready to sign an oil and gas lease, because there are some significant ramifications there with this new discovery. So, Justin, you want to talk about how this study went through the process of determining the estimated ultimate recovery of lithium that could be there? Because there's some assumptions and some modeling that goes into it. So it's not a perfect science, but just, it's helpful to understand, I think, how that's done.
Yeah, you said it, Matt. And, really, we're still at a stage where we're exploring this, trying to get a grip on it, truly understand it. And similar to the way that engineers will forecast it, they estimated unlimited recovery of natural gas or oil that a well will produce over its lifetime. The study performed this same type of analysis to forecast ultimate recovery of lithium across the state, as well as within two sub-areas, northeast and southwest Pennsylvania. In other words, they took the current produced water volumes and forecast those into the future, along with the known lithium brine concentrations to predict the amount of lithium that might be extracted. Because of some of the uncertainty involved in variation from well to well, they came up with a probability density function to come up with the maximum likely estimate of 1,160 metric tons per year across the state. And Matt, time will tell, and as they start recording true numbers, this will be adjusted and firmed up as we go. And Matt, there's a hidden challenge when it comes to the lithium hunt, something called magnesium to lithium ratio. It sounds technical, but it's pretty simple. The more magnesium there is in the water compared to lithium, the harder and more expensive it is to extract the lithium. It's like trying to find that needle in a haystack. The more hay there is, the tougher your job becomes. And Matt, this is something that will have a big impact on the economics of it. This is where Northeast Pennsylvania has another advantage. Its produced water has a lower magnesium to lithium ratio, making lithium extraction potentially easier and cheaper. Southwest Pennsylvania, with its higher ratios, might face a tougher and more expensive extraction process. Is a reminder of the world of resource extraction. What's in the water can be just as important as how much water there is. So it'll be really interesting to see how they go forward and, where the focus might be and if it shifts economics for operators.
Yeah, that's a great point. Just because it's there, like Justin mentioned, it could be that only portions of the state it's economic to extract it because of the water chemistry and all of the equipment and processing that has to go on, because it can vary. And again, this is looking at the data, looking at the total dissolved solid, looks at all of the different minerals that are dissolved in the water, and that they can come up with, okay, this is what the chemical profile looks like for this particular well. And they can look at an area, because the way that water is generally handled in Pennsylvania is they have central processing facilities. So they'll have gathering lines that take the water from the well sites into a central location where they can treat and either reuse the water or inject it downhole into a saltwater disposal well. And so what they would be looking at is, what's the overall chemistry of the water? Is it economic to extract the lithium, or is it just cheaper to do what they've been doing, and that's to just treat it to a level where they can inject it downhole and then maybe have a certain amount of that they can reuse for fracking new wells. So yeah, that's always the challenge. So another thing to think about, we've talked a lot about the challenge of maintaining production levels flat with these shale basins, and it requires continuous drilling of new wells. And this is because of the steep decline rate associated with these types of wells. In other words, you'll see a very significant drop in production over the first couple of years, and then it'll sort of plateau off and decline at a much more stable, almost linear rate into the future. But that the first couple of years, you could see like an 80% drop in production. And the same thing happens with water. So similar to the 80% drop with natural gas production, you see an 80% drop in water production. So if they have these water treatment facilities and lithium extraction facilities, in order to keep feeding the feedstock, the produced water into them, they're going to have to continue to drill lots of wells. And so the future of lithium extraction is really tied to the natural gas production, because it's a byproduct of natural gas production. So to the extent that it's economic for them to continue to drill natural gas wells, then this would be something that would happen. If it becomes uneconomic to drill wells, or for whatever reason, they slow down the pace of drilling, then obviously the lithium extraction potential would be directly affected. So talking about the bigger picture, Justin, right now, it's really kind of a good story, I think, in the Marcellus, that they reuse 95% of the produced water from those gas wells and recycle it to use it for fracking new wells. The reason I say this is a good story is because that limits the amount of fresh water that they have to use, because there are obviously environmental impacts to that. We have, if it's fresh water that's drinking water quality, then that's another use that we would want to balance. And then also irrigation, agriculture, all the other different uses for fresh water. And so the more that we can reuse produced water to use to hydraulically frack the new wells, the less smaller environmental impact we'll have overall. So I think that's overall a benefit. And, so that to the extent that they already have the transportation and processing facilities in place to deal with the produced water, it could just mean that they have to install these lithium extraction plants at these central processing facilities, where it makes economic sense. And then it could already be just an incremental cost to get the lithium out. So interesting potential here, Justin. And I think the important thing to think about is that the Marcellus Shale is not going away anytime soon. There's still a ton of untapped potential. North central Pennsylvania apparently is also an area that's largely undeveloped for natural gas production. And in the study, they mentioned that it has some of the highest lithium concentrations. So it could be another area that's even a higher potential for lithium extraction that just isn't really being sought after yet because of again, they haven't really gone after the gas there. But again, I think the huge potential of Marcellus Shale, we have decades more production, more drilling possible. So this is something that we could see lithium potential as a long-term play. This is not just a couple of year thing. I would think it would be a decades-long opportunity. But before we wrap up, Justin, I think let's talk a little bit about oil and gas leasing, because we talked about in the Smackover, it's really important to reserve your right to the lithium. And so when you sign a new lease, that you can get paid a fair royalty for that lithium that's produced. And that's something that's been really the big focus for those mineral owners in East Texas and in Arkansas, where the Smackover exists. And that's kind of where this activity is currently going on. But I think now this highlights the need, if you're in Pennsylvania, to really focus on your rights and focus on protecting your right to those other valuable minerals, not just the natural gas, which is kind of the well-known thing that they've been going after for a while. But what are your thoughts, Justin, on some of the takeaways or tips for mineral owners here?
No, I think you nailed it. I think it brings up a big question about how do you reserve the rights to this, ensuring that you're being paid for it in the lease. There's a lot of question marks about exactly how that's going to go in many different areas right now. And, Matt, it's a huge potential. I think it'll be really interesting to see what operator decides to really move in and move fast on this. Some of the operators don't always move too fast. And so I'll be curious to see how that goes. And there's going to be a lot of questions for exactly how the processing gets paid. It'll be interesting to see if this all comes through the operator, Matt, or if we start to see, a transporter type check that comes in for some wells is how the lithium gets paid. There's a lot to figure out, and we're just kind of scratching the surface and realizing the potentials that is there. We'll see how fast we get to making this viable and how serious the operators take it over the next couple of years.
Yeah, definitely. And of course, as we always say, this shouldn't be construed as legal advice. Be sure to hire an attorney that is qualified in oil and gas and minerals and royalties to help you with negotiating any oil and gas lease, and specifically the type of language that you would want to add to a lease that would reserve your interest in the lithium and the other extracted minerals that could exist. Because like we mentioned, there's, lots of other things in there. We mentioned the magnesium, but lithium is really the focus right now, but who knows down the road, maybe there could be a focus on other critical minerals or other minerals that are existing in that produced water that we really haven't seen the demand yet for, but that could change in the future. Maybe a new battery technology is discovered or something. And then all of a sudden we're looking at these other minerals. And so I think the long and the short of it is make sure you stay educated, make sure that you hire an attorney if you're negotiating a lease, especially if you have a significant amount of minerals, whether it's in Marcellus in Pennsylvania or any other area. Because again, we're finding that this is something that we're starting to look into more, and it could be something that's a potential in any basin or play where they're extracting oil or natural gas, where there's a large amount of produced water that has these minerals that are dissolved in it. So, that's definitely the key takeaway. And then we are seeing that there's a lot of advancements in this area, and we've been tied into the National Association of Royalty Owners, or NARO. And I know that we have several webinars and actual convention speakers that are going to be talking about this and other topics soon. And so if you haven't already joined NARO, definitely check it out. Go to join-naro.org and to learn more about becoming a member. And we have, again, lots of education opportunities, whether it's in our various webinars that are both live, and then we have a whole library of recorded webinars, and then also in our various state and national in-person conventions that you can attend to learn more about this. So yeah, definitely something to stay on top of things and see how it develops in Pennsylvania. Again, it's something that is on paper right now. It seems like there's a lot of potential. It hasn't really been exploited yet, but if it's there, there's somebody that's going to figure a way to extract it. And then you want to make sure you're getting paid your fair share in terms of the royalty.
You said it out.
All right. Well, thanks again for listening, and thanks again. And if you have any questions or concerns about lithium extraction in Marcellus, or if you're dealing with this in another area, drop us a line, feedback@mineralrightspodcast.com. And as always, we'll put the links to this study and the other articles that we mentioned in the show notes, which as always can be found at mineralrightspodcast.com. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.